Buddy. AI. A. KPI. KPI. KPI-VIX. KPI/CH. N. Good evening, and welcome to our market wrap-up. Today, global risk assets exhibited a distinct pattern of structural rotation within a low-volume, sideways trading environment, all while risk aversion quietly intensified. While major U.S. indices managed to close slightly in the green, the Nasdaq gaining a modest 0.1% to 26,274.13, and both the S&P 500 and Dow Jones Industrial Average edging up 0.19% to 7,412.84 and 49,704.47 respectively. These seemingly modest gains mask a far more complex and highly fragmented market underneath. Capital is actively chasing a few high-conviction themes, notably chip and energy stocks, while simultaneously rotating out of highly valued sectors to hedge against broader macroeconomic risks. Interestingly, the VIX Fear Index actually declined by 2.07% to 17.99, yet the 10-year U.S. Treasury yield climbed 1.20% to 4.46%, and the U.S. dollar index DXY strengthened by 0.13% to 98.29. The offshore yuan, USD/CNH, closed at 6.7919 in New York. Bitcoin saw a slight dip of 1.45% to $80,638.52, while WTI crude surged 2.69% to $101.85, and gold remained largely flat at $4,725.10. The main flow of capital today was unequivocal. It gravitated towards inflation hedges in the energy sector and the core of AI in semiconductors, with some funds also seeking refuge in US dollar cash. Reviewing the global path chronologically, the Asian session saw the A-share market oscillate at high levels after successive increases in volume. Despite high turnover, major indices closed lower, signaling divergence among investors and failing to set a positive tone for global markets. During the European session, market sentiment was dominated by escalating geopolitical risks in the Middle East, leading to heightened risk aversion and pressuring risk assets, thus failing to carry forward the previous day's strength in U.S. equities. The U.S. trading session proved to be the absolute inflection point for the day. After opening, the market initially dipped sharply on geopolitical news, but then executed a powerful V-shaped reversal, primarily driven by strong performance in the energy and chip sectors, ultimately pushing the three major indices to close marginally higher. This clearly indicates that the market is no longer in a broad-based rally but an extremely structured environment, propelled by a few key themes. Energy and semiconductor stocks emerged as the clear leaders, shrugging off macro pressures to become both safe havens and offensive spearheads for capital. Conversely, large